The term structure and interest rate dynamics. So this reading is about the term structure of interest rates. In other words, how do interest rates evolve with time, or what are interest rates across different time maturities? Specifically, we will start out by talking about the relationship between spot rates and forward rates. And here it's important to understand the difference between yield, a spot rate, and forward rates. Then we will move on to talk about the spot rate curve and the swap spread. So notice that there are many different kinds of rates, and you need to understand the difference between these different types of yields or rates. Then we will talk about the traditional theories that try to explain the term structure of interest rates. Again, the term structure of interest rates is this relationship between interest rates and maturity. Then we'll talk about yield curve factor models, and here we will understand the factors that influence the yield curve. And then we will move on to talk about managing yield curve risks. So with the yield curve, the risk might be that there is, let's say, a decrease in the yield curve. The risk might be that there is a change in the slope of the yield curve, because these movements in the yield curve affect a fixed income portfolio. The last segment of this reading is about developing interest rate views using macroeconomic variables. And again, this term structure represents interest rates, and for fixed income managers, it's important to have a view on how interest rates evolve, because changing interest rates impact the value of their portfolios. Let's now understand the concept of spot rates. A spot rate is the interest rate on a security that makes a single payment at a future point in time. The price or present value of a risk-free single unit payment after n periods is called the discount factor. The yield to maturity of the payment is the spot rate, and this is denoted by Zn. And the relevant formula is shown here. The discount factor for n periods is equal to 1 divided by 1 plus the spot rate raised to the power of the number of periods. Let's understand this through a few simple examples. Let's say we have a security that makes a $1 payment at the end of 1 year, and our periods here are going to be in terms of years. So there is a $1 payment that happens at the end of 1 year. Now, let's say that in this case, the spot rate is equal to 9%. So the yield to maturity on this security that makes a $1 payment at the end of 1 year is 9%. What is the discount factor? So DF1 is going to be 1 divided by 1 plus the spot rate, which is 9% or 0.09. Raised to the, all this is raised to the power of 1 because we have 1 period. And when we do this calculation, what do we get? We get 0.92. So this is for a 1 period security. Now let's say we have a 2 period security. So now this security makes a $1 payment at the end of year 2. And now I will tell you that the spot rate is equal to 10%. For this 2-year security, the spot rate is 10%. So we can say that Z2 is 10%. Now what's the discount factor? So DF2 is equal to 1 divided by 1 plus the discount factor, which is 10% or 0.1, raised to the power of 2 because we have 2 periods. And notice there is no payment in between. There's just this $1 payment at the end. It is a single payment. When we do this calculation, we get 0.87. So this is DF2 and Z2 is 10%. Now I want you to do this. What is DF3? And keep in mind that DF3 means that there is a payment of $1 at the end of 3 periods. So DF3 is going to be 1 divided by 1 plus, and you need the spot rate. So let's say that spot rate is 11%. So I'm telling you that Z3 is equal to 11%. So what will you plug here? You'll put 0.11 and this needs to be raised to the power of 3. And when we do this, we get 0.73. So what have we done? We have 3 different spot rates. Z1 is equal to 9%, Z2 is 10%, Z3 is 11%. And based on these 3 spot rates, we've calculated 3 different discount functions, DF1, DF2, and DF3. So hopefully the concept of spot rate and the concept of a discount function is very clear. Now let me emphasize the meaning of this yield to maturity. What does this mean? The yield to maturity means that when you buy the security here at time 0, the yield to maturity is 10%. So we calculated the discount factor here. That was 0.87. If we buy a security for $0.87 here at time 0 and hold it to maturity, and at maturity we will get $1. What is the yield to maturity? That yield, the annualized yield, is 10%. So that's why this is called the yield to maturity, and it is called a spot rate because with this security there is no cash flow in between. So we are going from 0.87 to 1 and there is nothing in between. So this is the yield to maturity and it is also the spot rate. Now that we've understood the concept of the discount factor, let's move on to the discount function. The discount function is simply the combination of these discount factors. So the discount factors for a range of maturities is the discount function. In other words, when we put together these discount functions, so if we say DF1 is this much, DF2 is this much, DF3 is this much, that is our discount function. The next point is the spot curve. So the spot curve is also called the spot yield curve. This curve shows for various maturities the annualized return on an option-free and default risk-free zero coupon bond with a single payment of principal at maturity. So notice with all these 3 securities, we had a single payment at maturity. So the question now is, with the 1-year maturity, what was the annualized return? With the 1-year maturity, the annualized return was 9%. With a 2-year maturity, the annualized return was 10%. And with a 3-year maturity, the annualized return was 11%. So if we connect these points, we get the spot rate curve. So this is our spot rate curve. And again, for emphasis, I will read this. The spot curve shows for various maturities the annualized return on an option-free and default risk-free zero coupon bond with a single payment of principal at maturity. So here obviously we are assuming that there is no default taking place. So we say that this is default risk-free. It is zero coupon in the sense that if we take the 1-year, 2-year or 3-year bond, there is no coupon payment or no intermediate payment. So this is our spot curve. Here we have maturity on the x-axis and the spot rate on the y-axis. From spot rates, we move to forward rates. A forward rate is an interest rate that is determined today for a loan that will be initiated in a future time period. So if A, B minus A represents a forward rate of a loan initiated A years from today with a tenor of further maturity of B years. So notice our terminology. When we use the term small f, this represents a rate. And I'll give you a simple example here. We are sitting at time 0, so this is today. If we want to lock in a rate for a loan that starts here, and let's say A is the end of year 1, so this is end of year 1, B is the end of year 3. So if we are locking in a loan that starts here, ends here, this is actually a 2-year loan. And the rate that we will agree today is called the forward rate, today being time 0. So the way we will write this is F1 comma 2. Small f again means that this is a rate. 1 means that the loan will start 1 year from today. So today is time 0. The loan starts 1 year later. And this 2 means that it is a 2-year loan. And the way we have written this over here is F1 comma 3 minus 1. So 3 minus 1 means 3 over here and minus 1 from here. But again, this is a 2-year loan. When we use the term capital F, so capital F, this represents the forward contract price for a 0 coupon bond with a unit principal which starts in the future at time A and ends at time B. So when we say capital F1 comma 2, this represents the price. If we have a 0 coupon bond that pays $1 over here, what is the price going to be at time 1? That is represented by capital F. And the relationship between capital F and small f is fairly straightforward. So capital F will be equal to 1 divided by 1 plus the forward rate. And this is 1 comma 2. And then raised to the power of 2 because we have 2 periods. So I hope you now understand the distinction between small f, which is a forward rate, and capital F, which is the forward price. The next point has to do with the forward pricing model, which connects the discount factors that we studied on the previous slide with the forward price that we have studied here. So the discount factor for B, so DFB, remember, would be the present value of $1 that is received over here. So the present value of this $1 over here would be DFB. And if B is 3 years, then this is DF3. So DFB is equal to the forward price multiplied by DFA. DFA is the discount factor for this period. Now I'm going to give you the justification for this formula. To understand where this formula is coming from, let's look at 2 alternative strategies that should give us the same result. So strategy 1 is that we buy a 0 coupon bond that pays $1 at the end of 3 years. So in this example, let's say A is 1 and B is 3. So strategy 1 is to buy a bond that pays $1 at the end of 3 years. What's the price of this bond today at time 0? The price is going to be DF3. And this is something we saw earlier. So DF3 is basically the $1 payment divided by 1 plus Z3. So Z3 is the spot rate raised to the power of 3. But anyway, the present value is going to be DF3. So this is strategy 1. Now strategy 2 is that we get into a forward agreement. So here at time 0, we want to lock in a rate for this period. And what is the symbol for that rate? That symbol will be small f and then 1 because this loan is starting out over here, comma 2 because this is for a 2-year period. If we get $1 at the end, so this is a 0 coupon bond that gives us $1 at the end, which is B is equal to 3. So at time 3, we get $1. What is the price over here at time 1? The price is going to be given by F1 comma 2. And I just explained where that's coming from. So this is the price of a 0 coupon bond with unit principal. So $1, which starts at this point, time 1, ends over here. So this is the price at time 1. Now to prevent arbitrage, the present value of this price or this F12 should be equal to DF3. And what's the present value of F12? To come up with the present value of F1 comma 2, we have to multiply this by DF1. So if we take this and multiply by DF1, that will give us the price over here. F12 into DF1. And this should be equal to DF3 to prevent arbitrage. And that is exactly what we are saying here. So the forward pricing model is DFB, and B is 3 in our example. That is equal to FA comma B minus A, which is 1 comma 2 in our example, and multiplied by DFA, which is DF1. So I trust this makes sense. Now, to properly understand this, we should work through an example. Consider a 2-year loan beginning in 1 year. So this is time 0. The loan begins here at the end of 1 year, and it is a 2-year loan, which means that we have 3 over here. So this is the 2 years for the loan. The 1-year spot rate Z1 is 7%. The 3-year spot rate Z3 is 9%. The first question is calculate the 1-year discount factor. So I trust this is very easy for you. The 1-year discount factor will simply be 1 divided by 1.07, which is 0.9346. Then calculate the 3-year discount factor. So this DF3 is equal to 1 divided by 1.09 cube, and this is 0.7722. Then calculate the forward price of a 2-year bond to be issued in 1 year. So we want the forward price over here for a 2-year bond, and the way we do this is we use the formula that we just saw. So the formula that we just saw was DF3 is equal to the forward price, which we need to calculate, multiplied by DF1. So what does this become? We know that DF3 is equal to this number over here. So 0.7722. This is equal to the forward price, which we get over here, multiplied by the discount factor. So DF1 is the discount factor for this period, and we know that DF1 is 0.9346, and based on this we can calculate F. So F is equal to 0.8262. So this is the price over here for a bond that pays $1. So if somebody gets $1 over here, the price of that bond is going to be 0.8262 over here. And then how do we interpret the answer? The interpretation is based on what I just said. If somebody gets $1 here at the end of year 3, the present value of that $1 is DF3. So present value at time 0 will be 0.7722. An alternative strategy is that somebody gets $1 over here, then based on the forward rate, the present value is F, that is this number, and the present value of that F at time 0 should be the same as DF3. So that is what we have essentially done with this formula. And based on that formula, we then get the value of F. We've talked about the forward pricing model, which is expressed in terms of the discount factors and the forward price. Now we are going to talk about the forward rate model, and we will look at how we can derive the forward rate model from the forward pricing model. It's actually quite straightforward. All we are going to do is take this discount factor and express it in terms of the spot rate. Similarly, we'll take this discount factor and express in terms of the spot rate, and then the forward price will be expressed in terms of the forward rate. And to make this even simpler, we will use the same numbers that we've used before. So we will take 3 periods, 0, 1, 2, 3, and we will use the 1-year spot rate and the 3-year spot rate and the 2-year forward rate. So what is the 3-year spot rate? So DF3 will be equal to 1 divided by 1 plus the 3-year spot rate, and then this is cubed. What about DF1? So DF1 is equal to 1 divided by 1 plus the 1-year spot rate. And if we are using the forward rate over here, so the forward rate for a loan that starts at the end of one period and ends over here, so it is a 2-year loan, the forward price is basically equal to 1 divided by 1 plus the forward rate and 1 comma 2, because this starts at the end of 1 year and it represents the rate for a 2-year loan, and this is squared. Now, if we use these expressions and plug them into the forward pricing model, what do we get? So instead of DFB, we are saying that B is 3 and we are saying that A is 1. So instead of DFB, we write this. So we say 1 divided by 1 plus Z3 cubed. This is equal to DF1 times F1 comma 2. So DF1 is shown here. That is 1 divided by 1 plus Z1 and then multiplied by the forward price. So the forward price is 1 divided by 1 plus F1 comma 2 squared. And then we can simplify this. Since we have 1 over something, 1 over something, 1 over something, we can just move everything to the numerator. That's basic maths. So 1 plus Z3 cubed is equal to 1 plus Z1 multiplied by 1 plus F1 comma 2 squared. And that is our forward rate model. So for this situation, this is the forward rate model. To generalize, we express in terms of A and B. All right, now let's look at an example. The spot rates for 3 zero coupon bonds are shown over here. Calculate the forward rate for a 1-year zero issued 1 year from today. So F11. So let's make sure we understand what's going on here. So we have 2 periods, 0, 1, 2, and we can use the same formula that we have just discussed. So 1 plus Z2 squared, what's Z2? That's 10%. So 1 plus 0.1 squared. This is equal to 1 plus Z1. So that would be 1 plus 0.09 multiplied by 1 plus F1 comma 1. So that is the forward rate for this period that goes from here to here. And based on this, we can calculate F1 comma 1 is equal to, this gives F11 is equal to 11.01%. Then next, calculate the forward rate for a 1-year zero issued 2 years from today. So 1-year zero issued 2 years from today. So now we have a 3-year situation, 0, 1, 2, 3. 1-year zero issued 2 years from today. So that would be for this period. And we use the same process. Here we will have 1 plus Z3 cubed because we want this period. So 1 plus Z3 is 0.11. So this cubed is equal to, we have the 2-year period. So that would be 1 plus Z2 squared, 1 plus 0.1 squared. And then this is multiplied by 1 plus F2 comma 1. 2 comma 1 because this begins at the end of 2 years and goes on for 1 year. From this we can calculate F2 comma 1 is equal to 13.03%. And then calculate the forward rate for a 2-year zero issued 1 year from today. So this again should be first written down, or first we should just see the timeline so we can understand what's going on. 0, 1, 2, 3, a 2-year zero issued 1 year from today. So that would be for this period. And overall we have 3 periods. So again we will have 1 plus Z3, which is 0.11 cubed, is equal to this period over here. So that's the discount factor, D1, 1 plus 0.9 multiplied by 1 plus F1 comma 2. So 1 comma 2 because this starts at the end of 1 year and then goes on for 2 years, and this would be squared. From this we get F1, 2 is equal to 12.01%. Based on your answers to 1 and 2, describe the relationship between the spot rates and the implied 1-year forward rates. So if you look at the spot rates are increasing. The 1-year spot rate is 9%, 2-year is 10%, and 3-year is 11%. And if we look at the implied forward rates, so the forward rate for this year, which is from the end of year 1 to the end of year 2, that's 11%. Then for this period, it is 13%. So notice that the forward rates are increasing. And this tells us something. A higher forward rate will also pull up the spot rates. And we'll discuss this in more detail later. We'll now talk about two interpretations of forward rates. Suppose F71, which is the rate agreed on today for a 1-year loan to be made 7 years from today, is 3%. So we have a situation, time 0 is today. This is end of 7 years. This is end of 8 years. And we are making a forward agreement, or we have a forward agreement, and this rate F71, which represents the rate for this period, is 3%. So what are two possible interpretations of this forward rate? One interpretation is that 3% is the reinvestment rate that would make an investor indifferent between buying an 8-year zero coupon bond or investing in a 7-year zero coupon bond and at maturity reinvesting the proceeds for 1 year. In this sense, the forward rate can be viewed as a type of break-even interest rate. So what this is saying is that here one strategy is to simply buy an 8-year zero coupon bond. So at time 0, the investor buys an 8-year zero coupon bond. There will be a certain price here, so DF8, and then the investor gets par value at the end. The other strategy is that the investor could buy a 7-year bond and then lock in a rate for this 8th year. And we can think of 3% as the rate that would make the investor indifferent between these two strategies. So if this is strategy 1, this is strategy 2, 3% is the rate which would make the investor indifferent between these two strategies. And in that sense, the 3% forward rate can be viewed as a type of break-even interest rate. So it is the rate which makes an investor break even between these two strategies. The other interpretation is that the forward rate is the 1-year rate that can be locked in today by buying an 8-year zero coupon bond rather than reinvesting in a 7-year zero coupon bond, and when it matures, reinvesting the proceeds in a zero coupon instrument that matures in 1 year. In this sense, the forward rate can be viewed as a rate that can be locked in by extending the maturity by 1 year. So what is being said here is that an investor could buy a 7-year bond and then receive proceeds over here at the end of 7 years and then invest for another 1 year. But the issue here is that the investor doesn't know what rate will be available at the end of 7 years. So instead, what the investor could do is buy an 8-year bond, so an 8-year zero coupon bond, and by doing so, the investor is locking in the rate for this period. And we are calling that the forward rate F7,1. If that is 3% and the investor buys the bond today and buys an 8-year bond, then effectively the investor is locking in the rate. And that's what's expressed here. So the forward rate can be viewed as a rate that can be locked in by extending maturity by 1 year. So these are the two possible interpretations of forward rates. Here we are given data from previous examples. So Z1 is 9%. So this is Z1 9%. F11 is 11%. 11.01%. So this is F11, that's 11.01%. And then we have F21, 13.03%. 13.03%. So this is time 0, time 1, time 2, time 3. This is information we have calculated or information we've been given before. The question is, show that the 2-year spot rate, which is Z2, and the 3-year spot rate, which is Z3, are geometric averages of the 1-year spot rate and the forward rates. So the question here is that you need to show that this 2-year spot rate, Z2, is a geometric average of these two numbers, and then Z3, which is the 3-year spot rate, is a geometric average of these three numbers. I want you to do this before you look at the solution. So here's the solution. This is Z2, and what is shown here is that 1 plus Z2 squared, so 1 plus Z2 squared is equal to 1 plus Z1 multiplied by 1 plus this rate, which is F11. And then based on this, we calculate Z2 as the geometric mean of the two numbers, of these two numbers. So it's the geometric average of the 1-year spot rate and this forward rate. And here, I hope you recognize that Z2, which is 10%, lies roughly in between the 1-year spot rate and then this rate. And this again shows that Z2 is a geometric average. And then if we take Z3, Z3 is 11%, and this 11% is a geometric average of the three rates, this rate, and this rate. So 9%, 11%, and 13.03%. Okay, next question now. We are given the three spot rates, Z1, Z2, and Z3. Determine whether the forward rate is greater than or less than the long-term rate Z3. So going back to our timeline, 0, 1, 2, 3, we know that Z3 is 11%. So this overall long-term spot rate is 11%. We know that Z1 is 9%. So this is 9%. Now the question is, this forward rate, what will it be? We've actually calculated this before. So we've calculated that rate to be 12.01%. Now, is it a surprise that this number is greater than 11%? Hopefully by now it should not be a surprise, because this 11% will come by linking together this rate with this rate. And the only way we can go from 9% for a 1-year spot rate to 11% for a 3-year spot rate is if this rate is higher than 11%. Then the next question is, determine whether forward rates rise or fall as the initiation date A for the forward rate is increased. So what this means is that over here in the first scenario, the initiation for the forward rate is A is equal to 1. But what if we make A equals 2? So we say that the forward rate starts here. So if we look at this forward rate, the question is whether the forward rate will rise or fall when we come here. And the answer is that the forward rate will go up. The reason is that spot rates are rising. So the 3-year spot rate is higher than the 2-year spot rate. And this will only happen if the forward rates are high. So these forward rates will pull up the spot rates. I'll also read this for you. The spot rates imply an upward sloping yield curve, which means that the longer term rate Z3 is higher than Z2, which is higher than Z1. Thus, the forward rates will rise with increasing A. So as we go further out, the forward rates have to be high in order to pull up the spot rates. This relationship was shown in example 2, in which F11 was 11%. So this was 11%, and then F21, which is this forward rate, is approximately 13%. Now, just to hammer in this point, here again, I'm showing you the same data that we've been using over the last few slides. We have the spot rates here and then the forward rates. Let's say this is the spot rate curve. So we have 1 year, 2 year, 3 year. The 1 year spot rate is 9%. The 2 year spot rate is 10%. So that's here. And the 3 year spot rate is 11%. When we have an upward sloping yield curve, so the spot rates are increasing as maturity goes up, then the forward rates are going to be higher. So this forward rate, 11%, is over here. This forward rate of 12% is over here. So notice the forward rates will be higher than the spot rates when we have an upward sloping spot rate curve. And if we have a downward sloping spot rate curve, so this blue represents the spot rate curve, then the forward rates will be below. So in this case, the forward rates will be pulling down, and this down pull is what causes the spot rates to come down. So if the spot curve is downward sloping, the forward curve will lie below the spot curve. So this is the forward curve and this is the spot curve. Over here, the red is the forward curve and this is the spot curve. So far, we've largely talked about spot rates, and spot rates are yields assuming no cash flow. So if we say that the 5-year spot rate is, let's say, 6%, that means that on a 5-year security, assuming there is no cash flow during the life of the security, the annualized yield is 6%. But the reality is that government bonds do have cash flows in the middle. So there are coupon payments. In most countries, coupon payments happen every 6 months. So we need to figure out a way of starting out with government bonds where there is a cash flow during the life of the bond, and then using that information to come up with spot rates. To do this, we need to understand the concept of a par curve. A par curve represents the yields to maturity on coupon-paying government bonds priced at par over a range of maturities. It can be used to construct a zero coupon yield curve, so this is basically the spot rate curve, through a process called bootstrapping. So again, just to emphasize the concept of a par curve, with a par curve, we have different maturities on the x-axis, and the y-axis represents yield to maturity on coupon-paying government bonds which are priced at par. And this is over multiple maturities. So we are given an example. We have a 1-year par rate of 5%. So a 1-year government bond that's trading at par. Here the yield is 5%. Then we have a 2-year par rate which is 5.97%. So for a 2-year government bond trading at par, the yield is 5.97, and then a 3-year par rate of 6.91. So this basically gives us a par curve. We are also given the 4-year par rate at 7.81. The curriculum shows how these par rates can be used to come up with spot rates. And the process is called bootstrapping. You don't need to understand the details of the process, but just at a basic level, you need to understand how this works. The learning outcome says that you need to be able to describe how this works. And if you understand this example, you'll be in good shape. Now, let's assume that these bonds pay annual coupons. We are told that the 1-year zero coupon rate is the same as the 1-year par rate. Why is this? Because with the 1-year bond, since we have annual coupons, there is no coupon or no payment in between. The payment is happening at the end of 1 year. So therefore, for a 1-year bond, since there is no cash flow in between, we can say that the yield is the same as the spot rate. So we can say that Z1 is equal to 5%. The 2-year bond and later maturity bonds, for them, the par rate will be different from the spot rate. And that's what we need to calculate. So first of all, let's come up with the 2-year spot rate. The process of deriving zero coupon rates begins with the 2-year maturity. The 2-year zero coupon bond is determined by solving this equation in terms of one monetary unit of currency. So let's say we are working with $1. The market value is 1. And let's say that the value for Z1 is 5%. This is already given. And we know that the market value is 1 because this bond is trading at par. So the bond is trading at par. The market value is 1. We take the first coupon. So for a 2-year bond, the first coupon is paid at the end of 1 year. And this coupon payment is going to be basically the yield, which is 5.97%. So the first cash flow is 0.0597. That's happening over here. This needs to be discounted at the 1-year spot rate, which is 1.05. And then we have a cash flow at the end. So at the end, there is the $1 par plus the 0.0597, which is coming from here. That is going to be discounted at the 2-year spot rate. And when this is done, we can calculate Z2. Similarly, to calculate Z3, we use this equation. So we take the 3-year bond, it's trading at par, so this is 1. Then we take each of the cash flows. So for the 3-year bond, we have a cash flow at the end of year 1, then end of year 2, and end of year 3. Cash flow at the end of year 1 is based on the coupon. So 6.91% of 1 is this number. This will be discounted at the 1-year spot rate. Then the cash flow over here will be discounted at the 2-year spot rate. And then the third cash flow will be discounted at the 3-year spot rate. The only unknown is Z3, and then that is calculated. And then the same procedure is used to calculate Z4. This overall process is called bootstrapping. And using bootstrapping, we come up with Z2, Z3, Z4, and that essentially is how we come up with spot rates. So we start out with the par curve, which gives us the par rates. Those rates are yields to maturity on bonds that do have intermediate cash flows. And based on that information, we come up with the different spot rates. Now, again, you don't have to do this entire calculation. You don't have to solve these formulas, but you just need to understand the process. In our discussion so far, we've touched on the concept of yield to maturity, but now let's discuss this in more detail. The yield to maturity is the discount rate that, when applied to a bond's promised cash flows, equates those cash flows to the bond's market price. So let's say that we have a 5-year bond which pays a coupon every year. So we have this bond, which is a 5-year bond, and there is a coupon payment. Let's say that there's a coupon payment of 10 that happens every year. And at the end of 5 years, there is the final coupon payment, plus there is a par value of 100. And let's say that this bond is currently trading for 95. The YTM is the discount rate, the single discount rate that, when applied to all these cash flows, will give a price of 95, which is the current market price. So that YTM can be calculated using a financial calculator. Again, it is a single annual yield, which, when applied to all the cash flows, gives us the current market price. The YTM is mathematically related to spot rates. The relationship is that the YTM is the weighted average of the spot rates used in the valuation of the bond. So strictly speaking, the valuation of this bond would be based on all these cash flows and the spot rates. So this first cash flow of 10 should be discounted at Z1, which is the 1-year spot rate. This should be discounted at Z2, and so on. And these spot rates will be different depending on the shape of the yield curve. The Z1 spot rate would probably be different from Z2, and so on. But the relationship that we are talking about here is that the yield to maturity, which is a single rate, is the weighted average of all the spot rates, and the weightage is based on the cash flow. So here, most of the cash flow is coming at the end. Therefore, when we come up with our YTM, given that the weightage of Z5 will be higher than the weightages of Z1 through Z4, we will expect YTM to be relatively close to Z5 compared to the other discount rates. Now let's look at this and understand it through an example. We'll use the same data that we have used in earlier examples. We have three different spot rates. The first question is, calculate the price of a 3-year annual coupon bond using these spot rates. Assume that the coupon rate is 5% and the face value is 100. So coupon payments are happening every year, and this is fairly straightforward. I'm sure you could do this too. We take each cash flow and discount at the relevant rate. So the first cash flow is discounted at Z1, second at Z2, third one at Z3, and this gives us a price of 85.49. This is the formal way or the arbitrage-free way of valuing a bond. Then I want you to do this. Write a formula for determining the price of the bond using the yield to maturity. Is Z3 greater than or less than the yield to maturity? So the first thing is to come up with that formula. So try to do that before you look at the solution. So hopefully here's what you did. We have the same cash flows that we see here, and then each cash flow needs to be discounted at a particular rate. That rate is the yield to maturity. So this is the yield to maturity for a 3-year bond. It is a single rate, and we want to find this rate such that we get the market price. The market price would be 85.49. And I hope you can use your financial calculator to determine Y3. The inputs are shown here. So 3 periods, we put in the present value and then the payment and the face value or future value, and then we compute the rate. This is going to give us the yield to maturity. This is the single rate which, when applied to all these cash flows, gives us the market price of the bond. The question is Z3 greater than or less than the YTM? And here you can see that Z3 is equal to 11%. And the yield to maturity is a little bit lower. So the yield to maturity is 10.93. So Z3 is greater than the YTM. The next question is why? And I hope you recognize this. We have said that the yield to maturity will be a weighted average of the spot rates. The spot rates are 9, 10, and 11. And we would obviously expect then for the yield to maturity to be somewhere between Z1 and Z3. In other words, we would expect the yield to maturity to be less than Z3, which is what we are getting. But this is also quite close to Z3 because most of the weightage in our weighted average will come from Z3. That's because most of the cash flow is happening here at the end of year 3. And this is also explained over here. Y3 is 10.93, which is less than 11%, but greater than Z1, which is 9%, just as we would expect, because the weighted yield to maturity must lie between the highest and lowest spot rates. Also, Y3 is much closer to Z3 than it is to Z2 or Z1, because the bond's largest cash flow occurs in year 3, thereby giving Z3 a greater weight than Z1 and Z2 in the determination of Y3. And again, Y3 is the yield to maturity for this 3-year bond. Now let's talk about YTM a little bit more. As we've said, the YTM is the discount rate that, when applied to a bond's promised cash flows, equates those cash flows to the bond's market price. I've said this multiple times. You've seen this written before, and that's because you need to remember this statement. The YTM is the expected rate of return for a bond that is held until its maturity, assuming that all coupon and principal payments are made in full when due and that coupons are reinvested at the original YTM. So there are multiple points being made here, and all these points are important. The first is self-evident, the fact that we assume that this is held to maturity. Yield to maturity means that this needs to be held to maturity for this measure to apply. So that's fairly obvious. Another obvious point is that we assume that all the coupon and principal payments are made. If these payments are not made, if there are some defaults, then obviously the actual yield will be lower. And the final point, which is not that obvious, is that if we have multiple coupon payments, so we have this, let's say, 3-year bond, there are coupon payments happening over here. The assumption is that these intermediate coupon payments happen at the YTM rate. So that also is an assumption of this measure. Our next point has to do with the relationship between YTM and expected return. Let's say we have a 5-year coupon paying bond. And for this 5-year coupon paying bond, let's say the coupon payments happen every year. So we have coupon payments at the end of year 1, 2, 3, 4, and at the end of year 5, there is a coupon and the face value. Let's say that the YTM on this is 10%. The question now is, if an investor buys this bond here at time 0, is the expected return equal to 10%? And the answer is that it depends. We need to recognize that the YTM is not necessarily a good estimate of the expected return. And there are several reasons for this. One is if interest rates are volatile. If interest rates go up and down, then the coupon payments that are received at these points will be reinvested at different rates, and because of that, the expected return might not be the same as YTM. The next point is that if the yield curve is steeply sloped, then also the expected return might not be the same. And this is fairly obvious if we have a yield curve that looks like this. This means that future rates are much higher than what we currently have, and therefore these coupon payments will be invested at higher rates. Or if we have a downward sloping yield curve, then future rates will be invested at or reinvested at lower rates. In either case, the expected return would be different from the yield to maturity. Then there might be a risk of default. If these cash flows are either not received or not received fully, or they are received late, then that also impacts the expected return. And the final point is that if a bond has embedded options, such as a call option or a put option or a conversion option, these options can change cash flows. They can change the timing of cash flows, and that will also impact the expected return. Therefore, we can say that for these multiple reasons, YTM is not necessarily a good estimate of the expected return. Now let's look at some questions. When the spot curve is upward sloping, the forward curve will be above the spot, below the spot curve, or coincident with the spot curve. So I want you to answer this. So what this is saying is that the spot curve is upward sloping. Will the forward curve be above this, below this, or same level? Now I hope you remember from our discussion that in this situation, the forward curve will be above the spot curve. And the way you can think of this is, if the spot curve is going up, that means that something else is pulling this up. And it is the interest rates in the future represented by the forward curve. And those future rates or those rates are pulling up the spot. So in this case, the forward curve will be above the spot. So the best answer is A. Which of the following statements concerning the yield to maturity of a default risk-free bond is most accurate? The yield to maturity of such a bond equals the expected return on the bond if the bond is held to maturity. Now, this is not necessarily true because while this bond is being held to maturity and it does not have any default risk, but we are told nothing about the shape of the yield curve. And we've just said that if the yield curve is sloping up, there's the steep slope up or steep slope down, that impacts the reinvestment rate. And because of that, the expected return might not be the same as the yield to maturity. Can be viewed as a weighted average of the spot rates applying to its cash flows. So this looks correct. The third option is that the yield to maturity for such a bond will be closer to realized return if the spot curve is upward sloping rather than flat through the life of the bond. So this is not true. If the yield curve is upward sloping, then that creates a difference between YTM and the realized return. If the yield curve were actually flat, then that's good. In that case, the YTM would be the same as the realized return, because then all the cash flows will be reinvested at the same rate. But here, the best answer is B. When the spot curve is downward sloping, an increase in the initiation date results in a forward curve that is, again, I want you to answer this. So what we are being told is that the spot curve is now downward sloping. And I hope you remember, based on this conversation and what we've said before, is that in this case, the forward curve will be below the spot curve, because it's the forward curve that's pulling the spot curve down. And when the question says increase in initiation date, what they basically mean is, when is this forward rate starting? So is this a forward rate for a period, one period from now, or is it a forward rate over here? And notice, as we go further out, in other words, as we increase the initiation date, the distance between the forward rate curve and the spot rate curve increases. So over here, the best answer is C, a greater distance below the spot curve. It is below the spot curve, and as we move to the right, the distance increases. So this is the best option. As we've discussed, forward prices and forward rates are based on current spot rates. So if we are sitting at time 0 and these are the spot rates, based on these spot rates, we can calculate the forward rates. So this forward rate is 11%, and then the forward rate here is 12%. If future spot rates evolve as predicted by today's forward curve, the forward price remains unchanged. So the point here is that we have a certain forward price over here based on this forward rate. And if we come to this point in time, so 1 year later, we are over here. If the 1 year spot rate is 11%, which is what was originally predicted, then this forward price will stay the same. On the other hand, if future spot rates turn out to be lower than what is predicted by the current forward rates, then the forward price will increase. So here the point is that if we start out at time 0, and these were the spot rates, and based on the original spot rates, these were the forward rates, and based on these forward rates, there are certain forward prices. If we come to this point in time, and now the actual 1 year spot rate is, let's say, 9%. The forward rate that had been predicted initially was 11%. But when we come here, the spot rate actually is lower. If this is the case, then the value of the forward contract goes up. So now the price of a bond for this 1 year period is actually more than what was originally estimated. Therefore, if we expect interest rates to come down in the future, then we should buy bonds in the forward market, because a bond that had been purchased in the forward market at time 0 would now become more valuable given the lower interest rates. So that's the point made here. If this is our belief that the rates in the future are coming down, then we should buy bonds in the forward market. And the opposite also holds true. If future spot rates turn out to be higher than what is predicted by current forward rates, then the forward contract price will decline. So in this case, the forward contract price will come down because interest rates are higher than what we had initially expected. Therefore, if we are expecting higher future spot prices, we should sell bonds in the forward market. As we've just discussed, active bond portfolio managers can outperform the bond market's return by correctly anticipating changes in interest rates relative to the projected evolution of spot rates. Now we are going to illustrate this point through an example. Let's say we have 3 zero coupon bonds. bond A, which matures in 1 year, bond B, which matures in 2 years, and C, which matures in 3 years. At time t equal to 0, this is the situation which should be familiar. We have the 3 different spot rates and we have forward rates which are implied by these spot rates. Now, one scenario is that as we move through time, so let's say at t equal to 1, this scenario pans out. So after 1 year over here, the spot rate, the 1 year spot rate becomes 11.01, which is what was predicted at t equal to 0. That scenario is described here. And what we will see is that if this actually pans out and the 1 year spot rate over here is 11.01, and then a year later the 1 year spot rate is 13.03, then whether an investor buys bond A or B or C and the investor's time horizon is 1 year, the return will be the same. The return is going to be 9%. So that is what is demonstrated here. If the spot curve 1 year from today reflects the current forward curve, the return on a zero coupon bond for the 1 year holding period is 9%, regardless of the maturity of the bond. The computations are shown here. For a 1 year bond, that's obvious, because if we buy the bond at time 0, it's a 1 year bond, the spot rate is 9%. So by definition, that bond will give a return of 9%. But what if the investor buys bond B, which is a 2 year bond? Here also, it can be shown that the return is going to be 9%. And you can see the calculations here. This is the price at the end of 1 year. So what's happening is we have a 1 year horizon. The investor buys bond B at time 0. And what we are trying to do here is estimate or calculate the price of the bond at the end of year 1. So this is a 2 year bond. At the end of year 1, the price is going to be this much. So it is 100, which is the par value, divided by 1 plus the rate. And the rate is going to be this rate because we are 1 year later and the 1 year spot rate is 11.01 in this scenario. Then divided by the price of the bond at time 0. At time 0, the price is the face value divided by 1 plus Z2 squared. So at time 0, the price is 100 divided by 1.1 squared. And the return will be this expression minus 1. And it can be shown that that is 9%. Similarly, for the 3 year bond, it can be shown that the return for a 1 year holding period is 9%. And again, all this assumes that this scenario does indeed pan out. Now, what if we have another scenario? In this other scenario, at the end of 1 year, the spot rate, the 1 year spot rate is 10%. So rather than going up to 11%, which is what was predicted initially, so at t equal to 0, the yield curve was implying that after 1 year, the spot rate will be 11.01%. But if the actual spot rate after 1 year is below what was projected, then what happens? So hopefully you can recognize that if the investor believes that the actual spot rate is going to be below what was initially projected, then it makes sense for the investor to buy a bond with a duration longer than the investment horizon. If the investment horizon was just 1 year, but the investor purchased a longer duration bond, let's say the investor purchased a 3 year bond, and then the investor turns out to be correct in the sense that the spot rate here is below what was projected, then the return for the investor will be more than 9%. And that's shown here. The first situation is where the investor just bought a 1 year bond. And there again, by definition, the return will be 9%. But if the investor bought a 2 year bond and over here, the spot rate is 10%, which is below the initially projected 11%, then the return is better than 9%. Then the return now is 10%. If the investor bought a 3 year bond, then the return is even better. So the return for a 1 year investment horizon is 13%. We now come to a strategy which is called riding the yield curve. This is also called rolling down the yield curve. If a trader believes that the yield curve will remain static over an investment horizon, he will buy bonds with a maturity longer than the investment horizon. So there are some key points here. With this strategy, the investor needs to believe that the yield curve will remain static. And also, if the investor believes that this is the case, then the bond that he will buy should have a maturity greater than the investment horizon. So let's say that the investment horizon is 1 year and the investor believes that the yield curve will remain static. So this is the yield curve at time t equal to 0. The investor believes that 1 year later, the yield curve will look the same. So the level will stay the same, the shape will stay the same. If the investor believes this, then he will follow this strategy called riding the yield curve. So the investor will buy a bond with a maturity longer than 1 year. Let's say the investor buys a 3-year bond at time t equal to 0. The price of the bond over here is going to be based on the rates given here. And the dominant rate will be the 3-year rate. So the price will be based on these rates. Now, 1 year later, if the yield curve remains static, then these same rates are in effect. So now the bond only has 2 years to maturity. So initially, the bond had 3 years to maturity. Now the bond has 2 years to maturity. So the relevant rates now will be 9% and 10%. If it's a zero coupon bond, the relevant rate will be 10%. And this means that the bond is now being priced at a lower rate or a lower yield, which means that the price is higher. So this gives a price appreciation. If these are coupon paying bonds, then there is the coupon income plus a price appreciation, and that is where the extra return is coming from. So if the investor's view is correct, the total return will be greater than the return on a maturity matching strategy. A maturity matching strategy would have been to buy a 1-year bond, which would give 9%, but this strategy will give a higher return than 9%. The total return will depend on the spread between the forward rate and the spot rate, as well as the maturity. So obviously here at time 0, we have a forward rate curve which is higher. We've talked about this before. The greater this spread, the higher the extra return. And also, the greater the maturity, the higher the return. So this, in simple terms, is the strategy which is referred to as riding the yield curve or rolling down the yield curve. Now let's look at some exam-style questions. Riding the yield curve strategy is executed by buying bonds whose maturities are, so you should be able to get this, we've just talked about it, longer than the investor's investment horizon. So that's the best answer. This next question has to do with the relationship between the expected spot rate and the forward rate. Now, hopefully you can answer this, and I'll also help you out a little bit. In the questions that we've seen before, we had a situation where the forward rate was 12% and the expected spot rate, so I'll call that ES, was 10%. If we have a situation where the expected spot rate is below the forward rate, then the bond is undervalued, which means that it will give an extra return. But over here, we are being told that the bond is overvalued. So this would happen if the expected spot rate is greater than the forward rate or higher than the current forward rate. So the best option here is C. Assume a flat yield curve of 6%. A 3-year £100 bond is issued at par, paying an annual coupon of 6%. What is the bond's expected return if a trader predicts that the yield curve 1 year from today will be flat at 7%? So the trader is predicting that the yield will go up. If the yield goes up, the price will come down, this means that the overall return is going to be less than 6% because the price is coming down. So there might be a 6% coupon, but there will be a loss in price. So the answer has to be A, because the only option that gives us less than 6% is option A. A forward contract price will increase if future spot rates evolve as predicted. Future spot rates are lower than what is predicted. Future spot rates are higher than what is predicted. So for the forward contract price to go up, the future spot rates need to be lower than what is predicted. So when the rates are lower, that's when the forward contract price will go up. So the best answer here is B. In this section, we'll talk about the swap rate curve, why it is used by market participants, and valuation aspects of the swap rate. So let's start out by talking about what is meant by the swap rate curve. The first thing to understand here is the swap rate. This is something that we see in the derivatives part of the curriculum, but we'll summarize the concept very briefly here. The swap rate is the interest rate for the fixed rate leg of an interest rate swap. So if we have an interest rate swap, with this interest rate swap, there will be a fixed leg and a floating leg. The floating leg could be LIBOR or it could be some other market reference rate. This fixed leg represents the swap rate. Let's say we have a 4-year swap. For this 4-year swap, there will be a fixed rate. Say that fixed rate is 5%, and there will be a market reference rate. Let's say that, and there will be a market reference rate which is a floating rate. If this swap has a settlement date every 6 months, then this will be a 6-month floating rate. The swap rate is this fixed rate. Now, next thing is the swap rate curve. This is also called the swap curve, and it represents the yield curve of swap rates. So the idea here is that we can have, let's say, a 1-year swap, a 2-year swap, a 3-year swap, and so on. In other words, we have swaps with different maturities, and for each maturity, there will be a certain fixed rate. So for a 1-year swap, there might be a fixed rate of, let's say, 3%. For a 2-year swap, there will be a certain fixed rate. For a 3-year swap, there will be a certain fixed rate, and so on. If we connect all these points, the fixed rates for swaps of different maturities, then that essentially is our swap rate curve or the swap curve. So notice that this is analogous to a yield curve because we are getting different rates for different maturities. Here on the y-axis, we have the swap rate. The swap market is a highly liquid market for two major reasons. The first is that unlike bonds, a swap does not have multiple borrowers or lenders, but swaps have counterparties who exchange cash flows. So we can have many more counterparties interested in exchanging cash flows relative to actual lenders and borrowers. And because of this, the swap market is more liquid than the bond market. Also, swaps provide one of the most efficient ways to hedge interest rate risk. So for these reasons, the swap market is relatively liquid. Earlier, we've said that government spot curves are used to value fixed income securities. That is true, but in addition to government spot curves, swap rate curves are also used to value fixed income securities. So therefore, we can say that government spot curves and swap rate curves are the chief reference curves in fixed income valuation. The choice between them can depend on multiple factors, including relative liquidity of these two markets, and then there are other factors that we'll talk about. But a major one is relative liquidity. The question now is when to use spot rates, government spot rates, and when to use swap rates. Let's assume that both markets are liquid. In this case, wholesale banks frequently use the swap curve to value assets and liabilities because these organizations hedge many items on their balance sheet with swaps. So the point here is that if an entity already deals with swaps and uses swaps to hedge risk, for such entities it makes sense to use the swap curve and then the swap rates that come out of this curve to value their assets and liabilities. And primarily, this will be used to value the bonds that they are working with. Retail banks, which have little exposure to the swap market, are more likely to use the government spot curve as their benchmark. So these retail banks will look at the spot rates associated with government securities. We should recognize that swap curves and treasury curves are different because of differences in their credit exposures, liquidity, and other supply-demand factors. So the fact is that government bonds are considered risk-free, whereas swaps do have some risk because swaps are between non-government counterparties. So the credit exposure is different. We've talked about the fact that the liquidity is different. In general, swap markets tend to be more liquid, and then supply-demand factors will also impact the rates. For these reasons, the swap curves and treasury curves can be different. Now let's talk about swap pricing. So the first question here is, what is a swap price? The swap price is the fixed rate on a swap. So if we have an interest rate swap, there will be a certain floating rate, and then there will be a fixed rate. And in this case, I've shown a party that is receiving fixed. There could be another party that is paying fixed and receiving floating. But the pricing of a swap is based on the fixed rate. If this fixed rate is 5%, then we say that the swap price is 5%. So the question is, how do we calculate this 5%? We solve for this constant fixed rate such that the present value of the fixed leg payments is equal to the present value of the floating leg payments over the life of the swap. So let's say we have a 3-year swap and payments are made every year. So 0, 1, 2, 3. If we take this point over here, we want to set the present value of the fixed payments. So how do we price this swap? We price it such that the present value of all the fixed payments is equal to the present value of the floating payments. Now, we say that the present value of the floating payments is 1. So let's say the par value of the swap is 1. And given the fact that if interest rates are moving up and down, the coupon payment of the floating rate security will change, and so will the discount factor. If there is no change in credit risk, the present value of a floater at a reset point is going to be par value. So this is the present value of the floating rate security. What about the present value of the fixed rate security? Here we will assume that there is a certain fixed rate S. So that's the fixed rate. What we take here now is the present value of all these fixed payments. So we have the present value of the payment at time 1. So this is S1, S2, and this final payment is ST, because we are saying that this swap is over T periods. So we take each payment and discount at the appropriate spot rate. So the first payment will be discounted at the 1-year spot rate, the second at the 2-year spot rate, and all that is captured by this expression. This is just the present value of all the fixed payments. Then we have a par value amount at the end. So at the end we have ST plus 1. 1 is the par value. That is discounted at Z capital T. This is something that we also discuss in detail in the derivatives segment of the curriculum. But you need to remember this formula, and to remember this formula, just remember this statement. You solve for a fixed constant rate that sets the present value of fixed leg payments equal to the present value of floating leg payments over the life of the swap. So that's exactly what is being expressed here. Keep in mind, so based on this formula, you can see that swap rates And spot rates are mathematically linked. So this is the mathematical expression that is linking the swap rate with the fixed rate. Sometimes you might be given discount factors rather than the rates. And as we've seen before, the discount factors can easily be converted into the spot rates. So we know that discount factor is equal to 1 over 1 plus Z1. So df1 will be 1 over 1 plus Z1. df2 is going to be 1 over 1 plus Z2 squared, and so on. Now, on the next slide, we are going to cover an example that deals with this equation, and it will also involve converting discount factors into spot rates. Suppose a government spot curve implies the following discount factors. Given this information, determine the swap rate curve. Now, as I just said, if you are given these discount factors, the first thing you can do is calculate the spot rates. And we've seen the relationship before. So df1 is going to be 1 over 1 plus z1. df2 is going to be 1 over 1 plus z2 squared, and so on. Given that we know the discount factor, the spot rates can be calculated. And if we do the calculation, we will come up with Z1 equal to 5%, Z2 equal to 6%, Z3 equal to 7%. So these are the discount factors converted into spot rates. Then we use the spot rates to calculate the swap rates. For that, we'll use the formula that we just saw. And that is shown over here, and this has been taken from the curriculum. First, we set t equal to 1. So here, essentially, we just have a 1-period swap. With a 1-period swap, the present value of the floating security is 1. So assuming a par value of 1, the present value of a floater is 1, and this is the present value of the fixed payments, just one fixed payment, and then 1 is the par value. From this, we can calculate that the fixed swap rate is 5%. And this makes sense because there are no cash flows in between, so we get the same number. Then the second one is more interesting. So here we assume t is equal to 2. Therefore, we have this S2. S2 represents the fixed payment for a 2-period swap. So this is the first payment discounted at Z1. Then the second payment discounted at Z2. This is the 2-year spot rate. And then the par value discounted at the 2-period spot rate. And this is always going to be 1 because the present value of the floater is equal to par. From this, we calculate S2 is 5.97, and then S3 is calculated the same way, that is 6.91. So this is for t equals 3. And then from this information, we can come up with the swap curve. So we have different maturities over here. In our example, we have 1, 2, 3, and then for each maturity, we have a swap rate. So for the 1-year maturity, we have 5%. For the 2-year maturity, we have 5.97. So that's this. And 3-year maturity, we have 6.91. So this is 6.91. So this is our swap curve. Moving now to the swap spread. The swap spread is the spread paid by the fixed rate pair of an interest rate swap over the rate of the on the run, which means most recently issued government security with the same maturity as the swap. For example, if the fixed rate of a 5-year fixed for float LIBOR swap is 2% and the 5-year treasury is yielding 1.3%, then the swap spread is 2%, which is the fixed swap rate for the 5-year swap, minus 1.7%, which is the yield on the government security, and this gives us 0.3% or 30 basis points. So essentially, the swap spread is the spread over a comparable government security. There are many reasons for the popularity of swap rates and the swap curve. One reason is that swap spreads reflect the default risk of private entities at a rating of about A1 or A+, which is roughly the equivalent of most commercial banks. Number two, swap market is unregulated. So swap rates are more comparable across different countries relative to government securities. And the third point is that the swap market has more maturities with which to construct a yield curve than do government bond markets. So for example, when we want to create this yield curve across different maturities, in the government bond market, there might not be actively traded bonds at several maturities. But with the swap market, given the higher usage and liquidity, it's relatively easy to find actual swaps with different maturities. So coming up with the swap curve is easier and requires less interpolation relative to coming up with a curve for government securities. A quick word here on the zero spread, which is also called the Z spread or the zero volatility spread. Although swap spreads provide a convenient way to measure risk, a more accurate measure of credit and liquidity is called the zero spread or the Z spread. The Z spread is the constant basis point spread that would need to be added to a government or an interest rate swap spot curve so that the discounted cash flows of a bond are equal to its current market price. So let me show this through a graph. Let's say that this is our spot rate curve. So this is our reference spot rate curve across different maturities. And let's say that we also have a bond which is currently trading at 95% of par. Obviously, this bond will have cash flows, so there'll be coupon payments and then there will be a final par value. So these are the different cash flows of the bond. Now, the Z spread is that constant spread over the spot rate such that when we discount all these cash flows associated with the bond, we get the market price. So we have to come up with this zero volatility spread, which is a constant spread over the reference spot rates. And this is the Z spread. It measures the liquidity and credit risk. Sometimes we just say credit risk, but that includes both liquidity and default risk. And the point here is that this measure is a more accurate measure of credit and liquidity compared to just a regular swap spread. In addition to the Z spread, there are some other spreads that you should be aware of. One of them is the TED spread. This is an indicator of the perceived credit risk in the general economy. TED is an acronym formed from US T-bill and ED. ED is the ticker symbol for the euro-dollar futures contracts. The TED spread is the difference between LIBOR and the yield on a T-bill of matching maturity. So for example, if we are working with 6-month LIBOR, then we will also take the 6-month T-bill and come up with the difference. An increase in the TED spread indicates a greater perceived credit and liquidity risk. So this makes sense. As I said earlier, LIBOR is an interbank offer rate. So banks lend and borrow from each other at LIBOR. And since banks are non-government entities, there is some credit risk involved. Therefore, we would expect LIBOR to be greater than the risk-free T-bill rate. The difference between these two is called TED. And if TED goes up, that means that the perceived credit and liquidity risk is going up. And if TED comes down, this means that the perceived credit and liquidity risk in the general economy is coming down. Another important spread is the LIBOR-OIS spread, which is the difference between LIBOR and the overnight indexed swap rate. This is called the OIS rate. An OIS, or overnight indexed swap, is an interest rate swap in which the periodic floating rate of the swap is equal to the geometric average of an overnight rate or overnight index rate over every day of the payment period. So here, the floating rate is defined differently compared to swaps that we've discussed earlier. The index rate, which I mentioned here, is typically the rate for overnight unsecured lending between banks. For example, this is the federal funds rate for US dollars. The LIBOR OIS spread is considered an indicator of the risk and liquidity of money market securities. And as before, if this goes up, so if the LIBOR OIS spread increases, this means that the risk and liquidity of money market securities is going up. As a side note, the secured overnight financing rate, or SOFR, which is the overnight cash borrowing rate collateralized by US Treasuries, is expected to replace LIBOR in the future. SOFR is calculated as the daily volume weighted index of all qualified repo market transactions and is influenced by supply and demand conditions in secured funding markets. So this is a change that's happening in financial markets, and you need to be aware of this. We'll now talk about traditional theories of the term structure of interest rates. There are several theories here, and they try to explain the shape of the yield curve. We start out with the local expectations theory. This theory has two flavors: unbiased expectations and local expectations. The unbiased expectations theory is also called the pure expectations theory. According to this theory, the forward rate is an unbiased predictor of the future spot rate. The implication of this theory is that buying a bond with a maturity of 5 years and holding it for 3 years has the same expected return as buying a 3-year bond or buying a series of 3 one-year bonds. So if we are to generalize this statement, the idea is that given an investment horizon, it doesn't matter whether we buy a short-term bond or a long-term bond. Regardless of the maturity of the bond, the expected return over a given investment horizon will be the same. This theory can be used to explain any shape of the yield curve. So for example, if the expectation is that future spot rates are going to be high, then the yield curve will be upward sloped. If the expectation is that future spot rates are going to be relatively low, then that would give a downward sloping yield curve. An issue with this approach is that it does not consider risk. In other words, this theory assumes that investors are risk neutral. The local expectations theory is more rigorous than the unbiased expectations theory. Here, the expected return for every bond over short time periods is the risk-free rate. An important assumption of the local expectations theory is that bond pricing does not allow for traders to earn arbitrage profits. There is no risk premium for short time periods. However, this theory does accommodate risk premium for long time periods. The idea here is that if an investor buys, let's say, a 10-year bond, then obviously the investor is taking on risk because interest rates will change, and the impact of changing interest rates will be much more on a 10-year bond versus another bond that is only a 1-year bond. And according to this theory, investors will be compensated or can be compensated for the extra risk they are taking. And in fact, it has been observed that short holding period returns for long dated bonds do exceed those on short dated bonds. So the point is that if an investor buys a 10-year bond and holds for 1 year, chances are that the investor's return or the expected return will be more than the expected return if the investor simply buys a 1-year bond. Next, we have the liquidity preference theory. The liquidity preference theory asserts that liquidity premiums exist to compensate investors for the added interest rate risk they face when lending long-term and these premiums increase with maturity. Given an expectations of unchanging short-term spot rates, the liquidity preference theory predicts an upward sloping yield curve. So if the expectation is that the spot rates in the future will remain flat, the liquidity preference theory will still predict an upward sloping yield curve because of the liquidity premium. For these longer maturity bonds, the interest rate risk is higher and investors get compensated for that higher risk through these liquidity premiums. So the longer the maturity, the higher the liquidity premium. According to this theory, the forward rate provides an estimate of the expected spot rate that is biased upward by the amount of the liquidity premium. So in simple terms, the forward rate will be approximately equal to the expected spot rate plus the liquidity premium. We can therefore say that according to this theory, the forward rate will be greater than the expected spot rate. So how is this different from what the pure expectations theory says? I hope you got that right. According to the pure expectations theory, the forward rate is an unbiased predictor of the expected future spot rate. So in that sense, the liquidity preference theory is saying something different from what the pure expectations theory was telling us. The existence of liquidity premiums implies that the yield curve will typically be upward sloping. So as you see over here, because of the liquidity premium, we would generally expect the yield curve to be sloping upwards. But now there is a theoretical question. According to this theory, can the yield curve be downward sloping? And the answer is yes, it is possible. Let's say that expectations about future spot rates are like this. And there can be a situation where even after adding a liquidity premium, the yield curve is still downward sloping. So this is possible, but not very likely, or this doesn't happen very often. Moving on to the segmented markets theory. According to this theory, yields are solely or completely a function of the supply and demand for bonds in a particular market segment. So we can say that the markets are segmented. And here we are talking about the bond market. Each maturity sector is considered a market segment. So we can have short-term bonds, medium-term bonds, longer-term bonds, and within this we can have bonds with specific maturities. Each of these would be considered a market segment. And the point being made here is that in each segment, the yield is determined by the supply and demand. So there will be a supply and demand in, let's say, the 5-year segment, and that will determine the yield. Also, different credit categories can be considered different market segments. So for example, we have investment grade bonds, and then we have non-investment grade bonds, which are called high yield bonds or junk bonds. So these are separate market segments also, and then there will be dynamics within these segments. The theory is consistent with a world where there are asset liability management constraints, either regulatory or self-imposed. So the point here is that many organizations that invest in fixed income securities have constraints. As an example, some investment managers might have a constraint that they can only invest in investment grade bonds. There might be pension funds where, to meet asset liability constraints, they can only invest in bonds with a certain maturity. There might be government regulations because of which investments are made in a certain segment of the bond market. So this theory is consistent with a world where various constraints exist, because of which these segments become very important. The preferred habitat theory is similar to the segmented markets theory in proposing that many borrowers and lenders have strong preferences for particular segments or particular maturities, but it does not assert that yields at different maturities are determined independent of each other. if the expected additional returns to be gained become large enough, institutions will be willing to deviate from their preferred maturities or habitats. And agents and institutions will accept additional risk in return for additional expected returns. So, for example, let's say that an institution has certain obligations, and to meet those obligations, the institution invests in 20-year bonds. But it turns out that the returns on, let's say, 15-year bonds is very high. And the institution then might take on the risk of moving into shorter maturity bonds to get that extra return. So this would be a calculated risk. And the preferred habitat theory accommodates the fact that some managers might want to take this risk to get the extra return. The earlier theory that we talked about, which is the segmented markets theory, is more rigid about the different segments. In that theory, it's not possible for investors to go from one segment to another just because the returns are much better. Now let's look at some questions related to term structure theories. I want you to try and answer these before you look at the solution. So in this first question, many fixed income portfolio managers are limited in or prohibited from high yield bond investments. When a bond is downgraded from an investment grade to a high yield rating, it is referred to as a fallen angel. Because of restrictions, many pension funds sell fallen angels when they are downgraded from investment grade to high yield. This coordinated selling action often results in depressed prices and attractive yields for the fallen angels. Which of the following reasons best explains why fallen angel yields often exceed otherwise identical bonds? So the issue here is that the markets are segmented in a sense between investment grade and high yield, and there is a constraint on certain managers that they can only buy investment grade bonds. So which theory does this remind you of? Is this the preferred habitat theory, segmented markets, or local expectations? So this is certainly not local expectations. In local expectations, the rates are completely unbiased predictors of future spot rates, and investors are considered risk neutral. So it doesn't really consider risk. So that's not the right answer. The choice is between preferred habitat and segmented market theory. Here, even though the high yield bonds, which are fallen angels, are offering attractive returns, it looks like the managers are still not allowed to go there. So for certain managers, that's a no-go zone. And that implies the segmented market theory rather than preferred habitat theory. So the best option appears to be B. Next, the term structure theory in which investors can be induced by relatively attractive yields to hold debt securities whose maturities do not match their investment horizon is best described as, now again, I hope you got this. The key point is that investors can be induced by relatively attractive yields. So the investors have certain preferences in terms of what yields they want, but they can be induced to move into another segment. This is the preferred habitat theory. And the idea here is that there is a preferred habitat, but it's only a preference. If the yields are more attractive next door, sort of in the next segment, then investors might hop over to the next segment. The unbiased expectation theory assumes that investors are, so this is very easy, unbiased expectations assumes that risk is not an issue and future spot rates can be predicted or are predicted by the forward rates. In other words, forward rates are unbiased predictors of future spot rates, and the assumption is that investors are risk neutral. Market evidence shows that forward rates are, and then are they unbiased predictors of future spot rates, upwardly biased predictors, or downwardly biased predictors? Hopefully you remember what I said here. So what we said earlier is that forward rates will be approximately equal to expected future spot rates plus a liquidity premium. So these forward rates will be higher than the expected future spot rates. Therefore, we can say that forward rates are upwardly biased predictors of future spot rates. Market evidence shows that short holding period returns on short maturity bonds often are less than those on long maturity, about equal to those on long maturity, and greater than those on long maturity. So here we are being asked about market evidence, not about a particular theory. And what we've discussed is that there is sufficient evidence which indicates that buying a longer term bond for a short period will give a higher return than buying a short term bond. So if our investment horizon is 1 year, buying a 10-year bond for that 1 year period is likely to give a better return compared to simply buying a 1 year bond. And that's because of the additional risk associated with the longer bond. So higher risk, higher expected return. So going back to the question, if we have short holding period returns, so that's let's say 1 year, a short maturity bond will give a return that is less than the return on long maturity bonds. So the best answer here would be A. Moving now to yield curve factor models. Here we will look at a bond's exposure to yield curve movement and factors affecting the shape of the yield curve. An important risk faced by portfolio managers is shaping risk. Shaping risk is defined as the sensitivity of a bond's price to the changing shape of the yield curve. The shape of the yield curve changes continually, and yield curve shifts are rarely parallel. Often in our discussion, we assume parallel shifts in the yield curve in the sense that we say that there is a certain yield curve. If the interest rates go up, then the value of a bond portfolio comes down. The implicit assumption here is that we have a parallel shift in the yield curve. In other words, interest rates or yields across all maturities are going up by the same amount. But the fact is that yield curve changes are not always parallel. There can be many types of changes, which we will see in more detail on the next slide. But over here, we are looking at historical yield curve movements in the US. If you look at the yield curves from 2006 to 2020, notice many different types of yield curves. So here we have a reasonably flat yield curve. Then we have a curve that is going up. Then we have a curve that's going up even more. So what you are seeing here is changes not only in the level of the yield curve, but the slope also changes, the curvature also changes, and that's the point being made here. For active bond management, a bond investor may want to base trades on a forecasted yield curve shape or may want to hedge the yield curve risk on a bond portfolio. So for example, if a yield curve currently looks like this, and a manager predicts that this yield curve will become steeper, so long-term rates might go up, short-term rates might come down, the portfolio manager might do something to take advantage of this view. So for example, if he expects long-term rates to go up, he might underweight long-term bonds and overweight short-term bonds. So this is just one example. Another portfolio manager might want to hedge the risk of something like this happening. Shaping risk also affects the value of many options, which is very important because many fixed income instruments have embedded options. So we have callable bonds, puttable bonds, convertible bonds. These bonds have embedded options which are impacted by changes in the yield curve. So shaping risk is particularly important in this context also. Curve movements are well described by a combination of three independent movements. And those three movements are the level, the steepness, and the curvature. And this is illustrated over here. We have the term or maturity on the x-axis, the yield on the y-axis. Let's say that originally we have this yield curve over here. So at time t equal to 0, this is the yield curve. So it is a flat yield curve and at a relatively low rate. Then at t equal to 1, we have this yield curve. So this solid line, this is the new yield curve. If we look at the change from this original yield curve to the new yield curve, we can see three types of movements. One movement is the change in level. So with this new yield curve, the average level is over here. So we can say that the change in level is from here to here. So this is the change in level. There is also a change in slope. If we take this new yield curve, on average, the slope looks like this. So the original yield curve was flat. Now we have a yield curve with a slope. We can say that the steepness has changed. So this is the second component, which is the slope or steepness. Also, this original yield at time t equal to 0 does not have any curvature. But over here, you notice a curvature. So there is a curvature in the sense that the medium term rates have gone up relative to this straight line, and the short term and long term rates are below the straight line. So this shows curvature, and that is the third component. All you need to take away from this is that when a yield curve shape changes, the shape has three components: the level change, the change in steepness, and the change in curvature. So far, we've talked about yield across different maturities, but it is also important to understand yield volatility across different maturities. Quantifying interest rate volatilities is important for at least two reasons. One reason is that most fixed income instruments and derivatives have embedded options. And I've talked earlier about callable bonds, puttable bonds, convertible bonds. These bonds have embedded options which are heavily impacted by yield volatility. Therefore, it's important to quantify volatility and understand the level of volatility across different maturities. Also, this is important for fixed income interest rate risk management. As we know, with fixed income securities, the price and value depends heavily on interest rates, which means that if interest rates are more volatile, then the risk of fixed income instruments will also be more. So for these reasons, it's important to understand yield volatility. The term structure of interest rate volatilities is a representation of the yield volatility of a zero coupon bond for different maturities. So in other words, if we say that this is a 5-year maturity, when we look at the yield volatility, we are looking at the volatility of a zero coupon 5-year instrument. The volatility curve or volatility term structure measures yield curve risk. So here is an exhibit from the curriculum which shows the historical volatility term structure for US Treasuries between August 2005 and December 2007. Notice that short-term rates are more volatile than long-term rates. So the volatility here with 3-month Treasuries is much more than the volatility of a 30-year government bond. And a major reason for this is that monetary policy has a much larger impact on shorter-term instruments. And with monetary policy, there is more uncertainty. The longer-term instruments are much less impacted by monetary policy. Therefore, the volatility is less. Another important point has to do with converting volatility from a monthly number to an annual number and vice versa. So the volatility numbers shown here are annualized. What if we want a monthly volatility number? If we have a monthly standard deviation or a monthly volatility, this can be annualized by taking this number. So this is 1015 or 10.15%. We multiply this by the square root of 12 because we have 12 months in a year. So multiplied by square root of 12, and that gives 0.3515 or 35.15%. This is the annualized number. And obviously, if we have the annualized number, which is what we are given here, and we want to come up with the monthly volatility, then we take the annualized number and divide by the square root of 12. This section is about managing yield curve risks using key rate duration. First, let's make sure we understand this concept of yield curve risks. The idea here is that when the yield curve changes, so this might be a parallel change, it might be a change in slope, it might be a change in curvature, these changes in the yield curve impact the value of a portfolio. And to try and quantify that impact, we use a measure called key rate duration. The focus of this segment is on key rate duration. But first, let's quickly review the most basic duration measure, which is effective duration. Effective duration measures the sensitivity of a bond's price to a small parallel shift in a benchmark yield curve. So this effective duration is simplistic in that it only considers a parallel shift. As an example, let's say that a bond has an effective duration equal to 5. This means that if the benchmark yield curve goes up by 1%, so this would be a parallel shift up, all rates are up by 1%, then the value of the bond will come down by 5%. Key rate duration, on the other hand, measures a bond's sensitivity to small changes in a benchmark yield curve at a specific maturity segment. So, for example, we might have a 1-year key rate duration which measures the sensitivity of a bond price to changes in the 1-year rate. We might have a 5-year key rate duration which measures the sensitivity of a bond's price to changes in the 5-year rate, and so on. To understand this concept, let's work through a simple question. Consider a portfolio of 1-year, 5-year, and 10-year zero coupon bonds with $100 value in each position. Total portfolio value is therefore $300. First, let's just compute the effective duration, and then we will compute the key rate duration. For effective duration, we should recognize that these are zero coupon bonds. So the effective duration of each bond is given by its duration or maturity. So for the 1-year bond, the effective duration is 1. Here it will be 5, and then this is 10. So if we take each of our 3 bonds, we have the 1-year bond, initial value is 100, and if there is a 1% change in the rate, so let's say overall the benchmark interest rate or the benchmark yield curve goes up by 1%, what will happen to the 1-year bond? The 1-year bond will go down in value from 100 to 99 because here the duration is 1. What about the 5-year bond? Here the value will go down from 100 to 95. And for the 10-year bond, the value will go down from 100 to 90 because for the 10-year bond, the effective duration is 10. So a 1% increase in the benchmark rate will cause the bond to go down by 10%. So the portfolio value will go down from 300 to 284. This is a 5.33% decline, which means that the effective duration is 5.33. A 1% increase in the benchmark rate will cause this portfolio to go down by 5.33%. Now let's compute the 1-year key rate duration. So we are computing the 1-year key rate duration. The assumption now will be that only the 1-year rate is changing and the other rates are not changing. So now the question will be, what's the value of the portfolio if only the 1-year rate goes up by 1%? So what will happen to the value of the 1-year bond? That will go from 100 to 99. The other values will stay the same. So the value of the 5-year bond will stay the same because the 5-year rate is not changing, so that will remain 100. The value of the 10-year bond will be unchanged also. So this means that the value of the portfolio is 299, and the overall portfolio is coming down from 300 to 299, which is a decrease of 0.33%. So now the 1-year key rate duration is 0.33. Now what about the 5-year key rate duration? With the 5-year key rate duration, we assume that the 5-year rate goes up by 1% and other rates remain the same. So therefore, the 1-year bond will stay at 100, the 5-year bond will come down to 95, and the 10-year bond will stay at 100. So the value of the portfolio comes down to 295. This is a decrease of 1.67%. So this is the 5-year key rate duration. And then we have the 10-year key rate duration. Here the assumption is that the 10-year rate goes up by 1%, which means that the 1-year bond stays at 100, the 5-year bond stays at 100, but the 10-year bond will come down to 90. The value of the portfolio is 290, and this is a 3.33% decline. So the 10-year key rate duration is 3.33. I hope you also recognize here that when we talk about key rates, we are concerned about the key rates for a given portfolio. In the context of this portfolio, the 3 key rates are the 1-year rate, the 5-year rate, and the 10-year rate, because that is what we have in this bond. So we don't really need to worry about other rates. These are the 3 key rates that we are concerned about. Therefore, these are the 3 key rate durations that we need to determine. Now, based on this conversation, we can come up with a measure for yield curve risk. The overall key duration for this portfolio can be written like this. So it is negative, and then key rate duration for the 1-year rate times the change in 1-year rate, then the key rate duration for the 5-year rate times the change in 5-year rate, and key rate duration for the 10-year rate times the change in 10-year rate. Given what we just calculated, we plug in 0.33 for the 1-year key rate duration, this is the 5-year key rate duration, and this is the 10-year key rate duration, and this is the overall formula. The benefit of this formula now is that we might have different changes that are happening at the 1-year level, at the 5-year level, and the 10-year level. And using this formula, we can measure the impact on the overall portfolio. So for example, if the 1-year rate increases by 10%, 5-year rate increases by 0.3%, and 10-year rate is unchanged, what is the approximate change in value of the portfolio? So I want you to do this. So hopefully this is what you did. We are essentially using this formula. So minus 0.33 multiplied by the change in the 1-year rate, which is 0.1%. Then we have minus and change in the 5-year rate. So we'll do 1.67 times the change in the 5-year rate, which is 0.3%. And then the 10-year rate is not changing. So for that, we'll simply have 0. Overall, when we do this calculation, we get minus 0.534%. So this is the change in the value of the portfolio given these changes in interest rates. And I hope you see the power of this. This does not rely on a simple parallel shift or a level change. This is useful even when the changes at different rates or different maturities are different. And I hope you can try and remember this formula. So actually, you need to remember this formula. On the exam, chances are that the key rate durations will be given to you. And based on the key rate durations and the changes in the different interest rates, you should be able to calculate the approximate change in value of the portfolio. Let's now consider our bond portfolio's sensitivity to parallel steepness and curvature movements. The proportional change in portfolio value that would result from a small change in the level factor given by this, the steepness factor, and the curvature factor is given by this equation. So notice this equation is similar to what we saw earlier. Rather than key rate durations, we have a duration for the level factor, then we have change in the level factor. Next, we have duration for the steepness factor, and then change in steepness, and then duration for the curvature factor and change in curvature. The question now is, how do we calculate these duration numbers? And the answer is that the values for these duration numbers can be derived using key rate durations, which we saw before, and the table given over here, which defines what we mean by a parallel movement, a steepness change, and a curvature change. So let's come up with these duration numbers. The easiest one is a parallel change. And what we see here is that a parallel movement means that all rates shift by 1 unit. So essentially, if we have a yield curve, we are saying that all rates are shifting by 1 unit. This means that this duration is our effective duration because we have a level or parallel shift. So our key duration for level changes or for parallel changes will be 5.33. This is the number that we calculated earlier. Now, what about the duration for steepness changes? Here we need to understand what's meant by steepness. So with steepness, we have a 1 unit decrease for the 1-year rate and a 1 unit increase for the 10-year rate. So if we start out with this yield curve, we have a 1 unit decrease for the 1-year rate. So let's say this is 1 year, this is 5 year, this is 10 year. Over here we have a 1 unit decrease. For the 5 year we are at 0, so no change. And 10 year we have a 1 unit increase. So we have something like this. And if we think about the impact on our portfolio, the original portfolio is 100, 100 and 100. So 1 year, 5 year, 10 year. With this change, what happens to the value of the portfolio? So 1 year we are coming down by 1 unit, which means that the value of the bond will go up by 1%. So the value of the bond will become 101. The 5-year bond is still at 100 because there's no change here. What about the 10-year bond? With the 10-year bond, we have an increase in yield of 1 unit, but here the key rate duration is 10. That means the value will come down by 10%. So the value comes down to 90, which means that this portfolio is now worth 291. So from 300, the portfolio has gone down to 91. This is a decline of 3%. So this duration sensitivity or this key duration for steepness is going to be 3. And then we have curvature. With curvature, we'll do the same exercise. So let's look at this over here. This is our original. The 1 year goes up by a unit. 5 year is the same, and 10 year also goes up by a unit. So what happens to the value of the portfolio? Over here we have an increase. So the portfolio value will go down to, so the 1 year bond will go down to 99. The 5 year bond will stay at 100 and the 10 year bond will go down to 90. This means that the portfolio value is 289, which is a decrease of 3.67%. So the key duration for curvature is 3.67. And these are the numbers over here. We can now put this in a formula, and this formula is basically what we have here, but instead of key duration for level, we've actually put in the number. So for our portfolio, and given these definitions of parallel change, steepness change, and curvature change, we have 5.33 for key duration level. Then for key duration for steepness, we have 3, and key duration for curvature we have 3.67. With this formula, it's now easy to estimate the change in value of a portfolio if we are given the factor changes. If we are told that the level factor increases by 0.1%, the steepness factor increases by 0.3%, and the curvature factor is unchanged, what is the change in value? So I want you to calculate this. So hopefully this is what you'll do. So minus 5.33 times change in level. What's the change in level? It is 0.1%. And then minus 3 into change in steepness. What is the change in steepness? That is 0.3%. So minus 3 into 0.3%. And then this is 0, so minus 0. So this into this, and then this into this. And when we do this calculation, we get minus 1.43%. So the answer to this question is that the portfolio value goes down by 1.43%. All right, let's look at some MCQ questions now. The most important factor in explaining changes in the yield curve has found to be level, curvature, or steepness. Now, I mentioned this, and if you remember, that's great. If you don't remember, you can learn now that the most important factor in explaining changes in the yield curve is level. Next, a movement of the yield curve in which the short rate decreases by 150 basis points and the long rate decreases by 50 basis points would be described as what? The best way to do this is to draw it out. So we start out with a yield curve. The short rate decreases by 150 basis points and the long rate decreases by a smaller amount. So what is happening here? So this is clearly a steepening and the level is also changing. So the level is going down and the curve is becoming steeper. So the first is flattening of the yield curve. That's not right. Second is steepening of the yield curve resulting from changes in level and steepness. So that is true. Steepening of the yield curve resulting from changes in steepness and curvature. So there's no mention of curvature here. The best answer therefore is B. A movement of the yield curve in which short and long maturity sectors increase by 175 basis points respectively, but intermediate maturity sector increase by 10 basis points is best described as what? So what's happening here is that we start out with a yield curve and we are told that long and short maturity increase by quite a bit. So at the short end, there is an increase of 100 basis points. Long end, there is an increase of 75 basis points. And in the middle, there is a small increase. So we have something like this. So there is a change in curvature and there is a change in level. So this change is both level and curvature. So the best answer is C. Typically, short-term interest rates are less volatile than long-term, more volatile, have about the same volatility. I hope you remember this. Short-term rates tend to be more volatile than long-term rates, and a major reason for this is that short-term rates depend a lot on monetary policy. And since monetary policy often changes, therefore short-term rates are more volatile than long-term rates. Suppose for a given portfolio, the key rate changes are considered to be changes in the yield on 1-year, 5-year and 10-year securities. Estimated key rate durations are given over here. So as I mentioned earlier, on your exam, these duration numbers, the key rate duration numbers will be given to you. So you really need to remember that very simple formula. What is the percentage change in the value of the portfolio if a parallel shift in the yield curve results in all yields declining by 50 basis points? So given these key rate durations, we just need to reproduce the formula. So we have this key rate duration for the 1-year rate. There is a minus for each of the terms in the formula. So there's minus, and then we have this key rate duration which is 0.5. Then we multiply by the change in the rate. If we are told that the rate goes down, is declining by 50 basis points, so 50 basis points means 0.5%, and since it's declining, we need to put minus. So we can work in decimals or in percent. I find percent easier. So minus 0.5%. Then we have the 2-year key rate, so minus, and then the duration is 0.7 multiplied by minus 0.5%, because this is also changing by 50 basis points. And then at the 10-year level, we have minus 0.9 and multiplied by minus 0.5%. When we do this calculation, we should get a positive number, because this is positive, this is positive, this is positive, and the number that we get is 1.05. So that is the answer. We now come to the final segment of this reading, developing interest rate views using macroeconomic variables. And we start by talking about an important concept, which is the bond risk premium. The bond risk premium is the expected excess return of a default-free long-term bond less the expected return of an equivalent short-term bond, or essentially the one-period risk-free rate. Now notice in this whole reading, we are focused on risk-free bonds. So this bond risk premium is also the extra return of a longer-term bond above a short-term bond or above a one-period risk-free rate. The other aspects of risk, like credit risk or a premium related to liquidity, is related to corporate bonds, bonds that have default risk, but we are not talking about those bonds over here. Even bonds that do have default risk, if they are long-term, the first premium that they will have is this bond risk premium, which is also called the term premium. It's also called a term spread, because this is a premium associated with the fact that the bond is a long-term bond. This bond risk premium or term premium is a forward-looking expectation and must be estimated. And over the next few slides, we will be talking about this bond risk premium and what are the factors that influence the variability of the bond risk premium. Now let's look at the factors which influence the yield of short-term and intermediate-term bonds. One major factor is inflation. Inflation explains about 2/3 of the short-term and intermediate-term bond yield variation. Now, we are not saying that inflation is 2/3 of the short-term or intermediate-term rate. What we are saying is that if we have a short-term rate, there is a variability in this yield associated with short-term bonds or intermediate-term bonds. 2/3 of this variation is explained by inflation. The other 1/3 is explained by economic growth and factors such as monetary policy. When we talk about long-term bond yield variation, here the primary factor which explains this variation is monetary policy. In fact, monetary policy explains 2/3 of the long-term bond yield variation, and the remaining third is largely explained by inflation. Now, speaking of inflation and monetary policy, let's look at what happens during an economic expansion and then what happens during an economic recession. During economic expansions, monetary authorities generally raise benchmark rates to help control inflation. So when interest rates are raised, that checks or controls inflation. This behavior of raising interest rates leads to a bearish flattening of the yield curve. And a bearish flattening is shown over here. So this is the original yield curve. When the monetary authority raises rates, the short-term rates go up more than the long-term rates. We are starting out with a normal yield curve, which is an upward sloping yield curve. And since rates are being raised, that is a bearish situation. So higher rates means that bond prices fall. So when we have an increase in rates, that's called a bearish sign. And this is flattening because short-term rates are going up more than long-term rates. During an economic recession or an anticipated recession, monetary authority cuts benchmark rates to help stimulate activity. Since rates are being cut, that means that the yield curve will move down. This is a bull steepening because short-term rates get cut more than long-term rates. So there is a greater influence on the short-term rates. Those rates come down more compared to these long-term rates. So this is a bull steepening. Central banks can also use asset purchases to influence the bond premium. With an asset purchase, so when central banks buy bonds, they inject money into the system. In other words, they are increasing the money supply. When central banks increase the money supply, this drives down the bond risk premium, and that stimulates economic activity. If the central bank wants to slow down economic activity, then it will do the opposite. So in that case, it will reduce the money supply. And reducing the money supply will increase the bond risk premium, which will dampen economic activity. There are other factors that also influence the bond risk premium, and those factors are fiscal policy, the maturity structure of debt, and investor demand. Fiscal policy, as you might recall, has to do with taxation or revenue and expenditure. Generally, when they are relatively high budget deficits or budget deficits increase, these high budget deficits require more borrowing, which influences both bond supply as well as the required yield. So the point here is that when the budget deficit goes up, the yields also go up. And the opposite is true in the sense that if budget deficits come down, then the yields on bonds also come down. With respect to the maturity structure of debt, longer-term government debt maturity structures are associated with higher excess bond returns. The increased supply of long-term maturity bonds raises the yield in that market segment. So when there is a larger supply of long-term government bonds, then the yield in the long-term segment goes up. With respect to investor demand, a greater demand from investors such as pension funds and insurance companies increases the price of bonds, and this reduces the bond risk premium. During times of uncertainty, so if investors are concerned that the economy might be heading for a slowdown or even heading into a recession, then there is a flight to quality. This means that investors will tend to sell high-yield bonds or bonds that have relatively low ratings and use that money to buy safer government bonds. And because of this, the government bond prices go up, which means that yields come down. So there is a bullish flattening. So what's happening is something like this. We have a normal yield curve. When the investors rush into the government bond market segment, generally more money goes into longer term bonds. Since more money is going into longer term bonds, the prices go up and the yields come down. So for longer term bonds, the yields come down more so than shorter term bonds. So we have a bullish flattening. Notice this is the original yield curve. Now this comes down like this. Now let's talk about possible strategies in different scenarios. If investors are expecting rates to fall, such investors will extend their portfolio duration, because if rates are falling, then bond values will go up and higher duration bonds will realize a greater increase. On the other hand, if investors are expecting rates to rise, then it makes sense for them to shorten their duration, because when rates go up, bond prices come down, and if the duration is relatively low, then the decrease in bond price will be lower. If investors are expecting a steeper curve, they will sell long-term bonds and buy short-term bonds. So if this is the original yield curve and investors are and investors are expecting a steepening like this, what makes sense is that they sell long-term bonds, so sell over here, because here the rates are going up and bond prices will fall. So it makes sense to reduce the exposure here at the long end and increase the exposure at the short end. Investors expecting a flatter curve will do the opposite. So they will buy longer term bonds and sell shorter term bonds. This final situation has to do with investors with a long only investment mandate. Such investors can alternate between bullet and barbell portfolios depending on their expectations. So let's say that a particular investor is expecting a bullish flattening. So the yield curve looks like this, and the investor is expecting a bullish flattening, which means he expects long-term rates to come down more, short-term rates to go down a little. And let's say the investor currently has a bullet portfolio. So has a bullet portfolio at, let's say, a 5-year maturity. Now, if the investor shifts from a bullet to a barbell has weightage at either end of the maturity spectrum. So this is a barbell with maturities here at the short end and maturities at the long end. The benefit of a barbell is that it has a fair amount of weightage at the long end, which means that when long-term rates come down, the value of this will go up a lot. And that can be a strategy that's used in this context. Okay, now let's look at an example. Morgan Salaz is a fixed income analyst responsible for advising fixed income clients about bond trading opportunities. In the current recessionary environment, the level of government bond yields is low and the term structure is nearly flat. Salaz's firm forecasts that after a brief recession, economic growth will return quickly during the coming 12 months. So the current situation is that the yield curve is fairly flat. Which of the following changes to the yield curve is consistent with Salaz's expectation of increasing economic growth over the coming year? So currently there is a recessionary environment. The forecast is that there will be a brief recession and then there will be economic growth. So one is decrease in level. This is not consistent. Decrease in the term spread of the long-term rates over short-term rates. So term spread is the difference between long-term rates and short-term rates, which we talked about earlier. One scenario is this will go down. The other is increase in term spread of long-term rates over short-term rates. Now the point is currently there is a recession, which means that in the short term rates are likely to be low, but the expectation is that there will be economic growth later. So if there will be economic growth later, then it is fair to expect that rates in the future will be higher, which means that the yield curve will probably change shape and it will start sloping upwards. So the best answer is increase in term spread, because here we can see that the yields for long-term bonds are now higher than the yields for short-term bonds. So the best option appears to be C. We are now done with this reading. I'll summarize the key points. We started out by talking about spot rates and forward rates. Spot rates are the rates or yields on a security that don't have any intermediate cash flows. So we can have a 3-year spot rate, which would basically mean that you get a security after 3 years, no cash flow in between, and the annualized yield on this is the spot rate. Then we talked about the relationship between spot rates and forward rates. If we have an upward sloping spot rate curve, then the forward rates, which are the rates in the future, are going to be above the spot rates. So if this is the spot rate curve, then the forward rates are going to be higher. With respect to the swap rate curve, these are derived from swaps. If we look at a regular interest rate swap, this plain vanilla interest rate swap will have a fixed leg and a floating leg. The swap rate is the fixed leg. We can have a 3-year swap, a 4-year swap, 5-year swap, and so on. So we can have swaps with different maturities. The fixed rate across the different maturities will give us the swap rate curve. We also talked about the various theories of the term structure of interest rates. This included the local expectations theory, which had two flavors, the unbiased expectations theory and the local expectations theory. Then we talked about the liquidity preference theory, the segmented market theory, and the preferred habitat theory. We talked about yield curve factor models, and here the central theme was that a yield curve will change its shape, and the change in shape has three basic factors. There can be a change in level, there can be a change in the steepness or slope, and there can be a change in curvature. Then the final part of this reading was about developing interest rate views using macroeconomic variables. So we talked about what are the variables that influence the term spread, which is the difference between long-term rates and short-term rates. We talked about the factors which influence the variability of short-term rates, the factors which influence the variability of long-term rates, and then what are the sorts of positions that can be taken so that investors can benefit from their expectations related to changes in interest rates or changes in the yield curve. So that is it. Now, as always, I want you to practice. Make sure you go over the examples in the curriculum, do all the IFT practice problems, and also work through practice problems from the curriculum. That is it. Best of luck.